Good afternoon, everyone. I'm David Scherer, Co-CEO, co-founder, Origin Investments. Thrilled that you were able to join us today. We have, I think this is our largest webinar to date. We have over 1,000 registrants. Many of you are partners. Some are interested in what we do, and others just want to get some data on what our beliefs are, what to expect next year in 24. I'm going to introduce my colleagues in a moment, but I will say before we get started, we've done this article. It started as an article, and one of our core values at Origin is accountability and transparency. So we started doing this 4 years ago, and we graded it. And so 3 years ago, we started grading the last year's predictions, and then we would write the next year's predictions. So this is our fourth year. We grade them every year. Our copywriter yesterday informed me that we have been reduced from 94% accuracy to 93. So I just want to disclose that. We're down to 93, but we're quite proud of how accurate we've been in a very volatile period. And then I'll also say, unlike any year prior, I will tell you that I am less certain about my predictions and opinions than I have ever been. And so you'll see that the article's coming out today. Already went to press release, and for the first time, I've written 2 paragraphs of basically scenarios of exogenous shocks that could produce outcomes that are different than what I believe. So in my reasoning, if you will, I always believe the world's a probability. It's not a certain outcome one way or another, but you have to invest towards where you see the asymmetric distribution could be. And that's what I'm doing again this year. But I will tell you, full disclosure, I'm less certain because I feel like there's a lot of exogenous variables that are quite large, including a Fed balance sheet that used to be 4 trillion, went to 11, now it's sitting at 9. We're kind of off the rails there. 34 trillion of debt, foreign wars, unrest in the Middle East. And I could go on and on and on. And by the way, also a presidential election, and how will that factor into next year's economic environment, and what will Congress and the president do in terms of trying to stimulate an economy into presidential cycle. So there's a lot going on. Okay. In terms of today, we're going to go over sort of point by point what our predictions are. Number one, I'm hoping that takes about 35 minutes. If you've been on a lot of webinars with me, I tend to always take more time than I promise. I'm going to try not to do that today. And then number two, we have your questions. I'm actually going to address one right off the bat, but we had dozens of questions sent in prior. We'll try to incorporate those into the presentation. If you feel like a question wasn't answered or wasn't answered in depth, just go to the Q&A feature and ask it again. I will tell you, I will be on this as long as it takes. I generally can see how many folks are on. If you want to stay on, if we're at an hour and there's 100 people on still, I'll stay on with you, and we'll continue to have the dialogue. So with that, I want to introduce Dave Welk, number one. Dave Welk came over from Deutsche Bank Reef in 2011. He's been with us 12 years. He leads all of our equity investments nationally and manages that team of professionals. Dave Welk is, I believe, our 3rd team member. We now have 60. So he's been around from day one, and we've really built the firm around his expertise, but also he's tremendous for culture. He's a team player. He's kind. He's a great manager of others and developer of talent. Dave, I will tell you, Iowa is tough. It's tough. It's tough when a team scores 6 points in a month. Is that statistically an outlier, Dave?
I mean, on so many levels, and I appreciate the intro, Dave, and the warm remarks. But defense does not win championships. I can attest to that. As the non-Big Ten champion that Iowa is, we had an all-world defense, and we could not find a way to score any points. So defense does not win championships. Sorry to say.
And so Dave will cover quite a few slides, and then I also want to introduce Ryan Brown. Ryan, you've been with us almost 4 years now, which is shocking because I want to say you're 23, but are you 23? Is that right?
24 now.
So, okay, my bad. You're 24. Ryan is our head of data science, and that's a rapidly growing part of our company. I'll embarrass him a little bit. I will tell you this, and I mean it. He's the most intelligent person I've met in my career, and unfortunately, that spans 30 years at this point. I wish I could say I've only been around 10 years in business, but that's not true. Um, he is uniquely intelligent, and you'll see that. He has built Multilytics, both he and his team, and I believe it's the best intellectual property, machine learning analytics for rents, but it's now starting to mushroom into other areas. So I'm super excited about you. A little bit of that work, Ryan. I will say that it has not translated this year, your machine learning, into your fantasy football outcome. So you do have limits.
Thank you, Dave, for your kind introduction. As far as fantasy goes, there's still one game left, so we'll see what happens. I could still just make the playoffs. Otherwise, I'm excited to share insights about Multilytics and our outlook as we move on to 2024.
Yeah, and that too, if you make the playoffs, that would be a true outlier. So okay. All right, so we're gonna get started. I want to address one question. I went through the questions, and this question really stuck out to me, and it was a question about if I had to invest today, where would I invest? And this is not a webinar about Origin or products, anything like that. I will say, if you're interested in any type of investing right now, and you'll get a flavor of this in this presentation, I would advocate credit. We have credit products at Origin, and you're welcome to explore those and compare those to other options. But that's where I'm investing personally, most of my investable capital. I like credit because I feel like you're getting higher returns than what I believe are the expected returns of equity for the next 12 to 24 months. So that's my answer to that. So thanks for that question. All right, let's start with the deck. So the first prediction, and when the article comes out, you'll see that this is literally just 1 through 10. And so we'll just go and we'll use that as a frame. So my first prediction is that interest rates will stay high. And I want to be clear when I say that, I'm comparing what I believe will happen in interest rates to what the market is now pricing in. And it's changed quite a bit, the market expectation in the last month. And so a month ago, if we had done this webinar, the 10-year note yield was around plus or minus 5%. And of course, the Fed funds rate hasn't moved. It was 5.25. It's remained 5.25, but the expectation of where Fed funds would be over time was keeping Fed funds much higher for longer a month ago. And where you really see that manifest is in the 2-year note yield. Because at the end of the day, the 2-year note yield is nothing more than the sum of each month of Fed funds. And it's the average of those. And if you looked at the 2-year note yield a month ago, it was plus or minus, it got as high as the low fives to around 5%. This morning, it's around 4.6. And so the big change in the market expectation is that now they believe there's going to be rate cuts, and they believe it's going to be relatively quickly, somewhere in the neighborhood of 75 to 100 basis points in 24. That's the market expectation. The 10-year note has also come down from around 5% to today. It's as low as, I believe, 4.12. I just checked. So a lot. I mean, if you think about as a percentage basis, the 10-year note yield is down 16, 17% in a month. Think about if the stock market went up or down 17% in a month. I mean, that's unheard of, but yet it happened in interest rates, and it equally went up as fast the few months prior to that. So there's a lot of uncertainty in interest rates still. You see it through the volatility and the movement, and you see it by what I'm saying, which is I'm less certain for these reasons than I've been in the past. However, excuse me, I believe that the Federal Reserve is more likely to be cautious in starting to reverse their policy from rate hikes to rate cuts. if you go back to the Volcker Fed of the early 80s when they were combating inflation, they made the mistake of stopping the hiking process, and then they had to restart it again when inflation spiked. And I think the Fed today wants to try to avoid that. My bet is it's more like 25 to 50 basis points next year. So big difference. And if you look at the Fed funds rate, you see that we have it over the next year coming down, but we have it coming down to about 5%, 4.75, that range, which is different than the market expectation today. In terms of the tens, similar. In the article, you'll see I talk about rates fluctuating in a range between 3.5 and 4.5. Today we're at 4.12. So I see volatility actually being a bit less, and that's good. That helps the market. We need stabilized interest rates to start the transaction process again. But I also think that it's going to stay a little bit higher than the market expectation. And the reason for that is the inflation rate, which is here, the blue graph. And what's important is the far right side. Obviously, what's before it has already happened. I believe inflation is going to come down. Right now, it's around 3.5. I think it gets to 2.7, 2.8, 2.9, that range next year. However, the market thinks it'll be lower, and the Fed target is 2. And so I think it'll go down, but it'll go down slower than we think. It'll be led by housing, meaning the downward pressure, because housing is measured by rents, and rents have been flat to negative this year. And those leases will reset throughout 24. I also believe, and we'll get to this later, that rents are towards the end of their negative cycle. And I think that will also reverse the inflation in 25 to a more positive inflation. But big picture, there needs to be a real return on bonds. So, for example, right now, the real return on bonds, if you believe inflation is 3.5, and you believe, we know that the yield is about 4.15. There needs to be a real return. So if I'm telling you I think inflation is going to be 2.8, 2.9 next year, let's say the real return needs to be 70 to 100 basis points. I'm telling you that rates are pretty fairly priced here, meaning we need a 10-year yield of 3.5, 3.8, 4, 4.2. These are the ranges we're talking about. Next slide, please. So a recession is likely, and by the way, this is my second prediction. A recession defined as slowing growth to zero growth for 2 consecutive quarters. This is a pretty bold prediction because any of the folks on that are following GDP, it's been quite strong. Q3 GDP was really strong. And so this is really stepping out. And by the way, I was also wrong about this last year. And so for those who want to hold me accountable, that's why we went down in our accuracy. And it's because I thought there'd be a recession this year. I was wrong about that. Primarily, I think because as much as the Fed was trying to reduce the money supply, M1, M2, Congress was actually using fiscal stimulus pretty aggressively throughout the year. The CHIPS Act, the Infrastructure Act, there were a lot of things coming out of DC that were very different than what the Fed was trying to do. That's also why that's an exogenous variable I can't account for. If they do that again next year, I'll be wrong about this again. That's tough to predict. I can tell you they probably shouldn't. That's my opinion, but that doesn't mean they won't. So here we're looking at credit card delinquencies and housing delinquencies, and it's not a great graph to look at. Obviously, you're seeing that they're ticking up. It shouldn't surprise you, because if you think about the cost to finance homes, if you didn't lock your rate, it kind of went from 3.5 to 7.5. Credit cards a little bit more. Let's call it 500-600 basis points, or 5 or 6% more to finance the credit card debt. Same with cars. Cars kind of went from 4 to 9. And so my point here is, if the value of these assets haven't gone down, and home values haven't gone down, and car values haven't gone down, and it's costing really double to finance, I don't see how the math works. I understand people are making more in wages, but not enough to offset those massive expense differences. So it's fine if you're in kind of the top 5% of earners, but if you're not, it could be very difficult to continue to have the same level of lifestyle, and so people tend to trade down and they make other decisions. And we have to keep in mind the U.S. is a 68% consumption-driven economy, and so that's where our GDP is coming from. And so anything that's going to affect the behavior of a consumer will ultimately affect the GDP and the growth of an economy. And I don't think we get out of this without paying the piper at some level. And so that's my prediction. In exactly 12 months, you can hold me accountable to that. Okay. Next slide, please. So within this paradigm, I'm telling you that multifamily market fundamentals will remain strong. What's interesting is even now, and Dave Welk will cover, I'll touch on this in a moment, but he'll go into deeper detail about where distress could emerge in multifamily. But what's interesting is multifamily is already corrected, and I'll get to that on another slide, but it's corrected within a paradigm that demand is incredibly strong. And that's rare. You know, it's rare that you say, wow, our demand's never been stronger and assets are going down in value. That's interesting. But there's two things to keep in mind. Number one, interest rates have gone up at the fastest pace, percentage pace in US history. Think about it. The 10-year note yield was sub 1%. Now it's, low fours. It got as high as 5. No one's seen that in their lifetime. No one's seen that in the history of the country. Fed funds even more so. Fed went from essentially 0 to 5.25. Can't even measure that. That's an infinite increase. And so this is a lot to digest. So what's happened? And I touched on this. Because residential housing hasn't repriced at all. In fact, it's higher than it was in 22 and 23. And this is driven by a lot of variables that Dave Welk will get into, so I won't. But because it hasn't repriced, and because the mortgage has gone from essentially 3 to 7, and insurance has gone way up, and taxes have gone way up, you're left with, and that's the graph. The blue is the cost to own a home, and then below it is the cost to rent that same home. And so if you have a condo in Florida, you want to buy it, when you're done buying it, the HOA and the taxes and the financing and everything else, it's going to be $1,000 more a month than to rent. And by the way, if you look at the graph below, the bar graph, it shows that spread, which essentially was almost zero. And what happens, it's quarter by quarter, it spikes in 22, and that shouldn't surprise you because home prices kept going up, multifamily values went down, and interest rates spiked. And so you're just left with a countless number of people that can't afford a home now. And they might want to be in a home, but until either interest rates go back down or residential prices correct, they can't. We either are in a cycle that'll correct the other way, and you'll see the spread go back to normal, or we're in a paradigm shift where owning a home in the U.S. has now become, especially in the growth markets, Southeast, Texas, Southwest, but certainly New York, California, in those areas of the country, owning a home is now a privilege, and it'll be afforded to people who are in the top 10%. And if you're not, you're just going to be priced out. I don't think that's the case, but it could be. We could be literally staring at a paradigm. If that's true, then the demand segment for multifamily is enduring, and we're going to keep taking market share of people that can't afford a home. So I believe fundamentals will remain strong next year on the demand side. Next slide, please. So new multifamily development will come to a standstill. This is a really easy prediction. This is how I pad my my percentage of accuracy. I already know this because we're one of the larger developers, certainly in the Southeast, Southwest Texas, in the country, and we've seen that it's just completely fallen off a cliff. And so if you look at this graph, these are supply, or these are deliveries, and so this shouldn't surprise you. It takes about 2 to 3 years to build, and so rates were really low in 20 and 21. And so if you look into 23 and 24, that's all the supply that started in this really low rate environment, and we're in it right now. And then you also see that it's going down at a really fast rate. I would tell you that it's going down even faster than this graph shows. In many of the markets, it's down 60%, 70%, 80% from where it was a year ago, and that's because a lot of reasons. But I would summarize it as the margin on new development is quite low, based on rents that are flat, expenses that are higher, interest borrowing expenses that are higher, cap rates that are higher, building costs that really haven't come down enough. They've flattened, and certain instances come down a little. But development is an equation, and most of the variables in the equation have gone the wrong way at the same time, which is very rare because a lot of these variables counteract each other. So I'll give you an example. If rents are flat, you're probably in a recession, so interest rates should be coming down. But that's not happening right now. I mean, certainly they're coming down this month versus last month. But if you looked at a 4-month, they're actually higher. And so we're still in a rising interest rate secular move while rents are flat. Or I could do this on and on and on, but the point is they're supposed to counteract, and they're really not right now. They're all kind of going the wrong way. That will also turn around. I'm certain of that. But right now, there will be very, very little in new development. And then what will happen is, if you look 2 years out again, so now let's get to late 25, early 26, 27. We have a housing shortage in the U.S., and it's getting worse and worse every day, every quarter. Another reason there isn't a lot of development is SVB Bank failing, Signature Bank failing, regional banks getting really scared about their own existence. It was existential. They're very reluctant to lend, and they're guarding their cash, and they're hoarding their deposits, and they've really taken money out of the system, and it's very difficult to get construction loans. And if you do, you get them to 52, 55% leverage. They used to lend to 70. So that paradigm is limiting development. It's also creating huge opportunities for Origin on our credit side, because we're able to fill in those capital structures at really interesting levels of return for the risk set. Next slide, please. So elevated multifamily valuations have mostly corrected, but I believe in 24 you'll see the bottom. I'm sort of calling that. I think that a year from today will kind of be the bottom. Why do I think it'll be about a year from today? Because I think there was a record amount of transactions in 21, and Dave will cover this on the debt side. Lots of those transactions were financed with floating rate debt. Lots of that was debt fund debt. Lots of those terms of debt were 2 to 3 years. And so all that debt is sort of coming due in 24. It's expiring. It has to find new debt. And so I think that the lack of transactions you see this year will be replaced by real transactions next year. And a lot of those transactions are going to be at prices that are quite surprising to investors, because what I said before, the fundamentals are incredibly strong. So my outlook on next year is you're going to have really interesting buying opportunities, and you should take them. I think that this is a fortress asset class over the next 10, 20, 30 years. It certainly has been over the last 30. Highest returning, lowest risk real estate asset class. I believe that'll continue. I don't think it's disruptible either by technology. We have a fundamental need for housing and shelter, and we're undersupplied. The problem is too many transactions happened in 21 and early 22 at irrational valuations. We never should have had cap rates at 3.3, 3.4, never. We're historically an asset that grows at 3%. You shouldn't pay 30 times multiple on that. You should not. And we kind of voted with our checkbook. Origin hasn't bought a building in 4 years. We're a firm with billions of EUM. We didn't buy a building for 4 years. We were wrong, by the way, in 21 when everything was going up so fast. We hadn't bought anything. We're not wrong right now, but I do think there will be a real opportunity in this. And by the way, the other thing I want to cover is it's already corrected. And so if you're in a deal or a fund and it's equity, and they're saying it's unchanged, that's just impossible. Valuations are down anywhere from the most protected assets in the best markets, from peak, by the way. Peak means that irrational spike in 21. They're down anywhere from 15 to 30%. There's not a lot of transactions, but I'll cite a few. And these are the transactions I'm going to cite. I'll be very brief, but one asset in Phoenix, one asset in Tampa, both relatively new, both traded at 30 or 40% above replacement cost in 21 and early 22. That should never happen. That's one of the reasons we didn't buy. As a compass, whether you're investing with Origin or on your own, don't pay that high over replacement cost ever for real estate. It's a losing proposition. In this case, the assets were a few years old too, which makes it worse. They're buying not new product at 30 to 40% of replacement. And so now the assets have corrected 30%. And they're essentially, in both cases, they traded at around 400,000 a door. Now they're trading plus or minus 300,000, a little sub 300, 288 a door. And these are real transactions happening right now. And in the case of the Phoenix asset, it was financed by a debt fund that has now seized control of the asset and selling it. It's a good asset that the last buyer just paid too much for. Fundamentals are sound. They just paid way too much. And at the price it's trading today, where Origin still isn't a buyer, we would entertain buying it at about 10% below here, because although it's trading slightly below replacement, which is one compass, it's a solid asset in a good market. It still doesn't have positive leverage. So if you're buying it at a 5.25 and you're financing it, the 10s today are 4.2 and the spread is generally about 170, you're still borrowing in the high fives. That's negative leverage. And so I don't want to buy assets and get negative leverage, to have a lower return that's levered than unlevered. And so these things still need to work out. And again, when I talk about residential needing either to go lower in price or rates need to go down, that same dialectic applies to multifamily. And so I think that you're still going to see a little more correction next year, not much, and it'll be driven by expirations that Dave will cover. Next slide, please. I think this is my last slide. So I'm going to introduce, I'm actually just going to hand it to Dave Welk, and I'm going to try to address the light issue I'm having on the left corner of my screen. Dave?
Thanks, Dave. I actually think, Ryan, next slide might be yours.
Well, before we jump into that slide, I think I'm just going to go ahead and talk a little bit about Multilytics, and then we'll jump into the predictions for 2024. So I'd like to kind of walk you all through how we've gotten here. The inception of Multilytics traces back to my undergraduate years at the University of Chicago, where I was deeply immersed in spatiotemporal research and simultaneously working as an intern for Origin Investments. Our journey commenced with the ambition to decode the intricacies of rent growth forecasting. My academic endeavors, culminating in an honors thesis, along with my professional work at Origin, concentrated on scrutinizing the effectiveness of existing predictive models in multifamily. A pivotal question drove our quest. Could we enhance the accuracy of forecasts beyond current benchmarks and conventional models? The exploration fostered the development of groundbreaking methodologies, challenging orthodox modeling assumptions. We redefined our perception of submarkets and integrated advanced spatial features into our analysis. Collaborations with domain experts at Origin and leading figures in spatial econometrics, such as Luke Anselin and Marinia Kolak, enriched our research. This exhaustive endeavor culminated in a robust model confidently deployed in 2021 after exhaustive backtesting. I should note here that such backtesting also led Origin to dropping leading forecasters from our underwriting approach. I will let you all interpret what that means. However, initial results in 2021 appeared startling. Our model predicted unprecedented rent growth in areas like Gilbert, Arizona, projecting over 30% year-over-year increases, in stark contrast to industry leaders who are generally forecasting flat to negative rent growth nationwide. Doubts crept in, and we began questioning the validity of our model. In fact, I was almost ready to scrap all of my research and start a new thesis before it was too late. Yet, as 2021 unfolded, our predictions not only held true, but were slightly conservative in estimating actual rent growth. Encouraged by our 2021 success, our 2022 performance further validated our approach, both on a relative and absolute basis. In late 2021 and 2022, our model started indicating a probable downturn in year-over-year rent growth for 2023, contrary to prevailing market forecasts. As such, we decided to publicize our predictions. The subsequent market trends with negative year-over-year rent growth in numerous U.S. markets resonated with our forecasts, corroborated by both our proprietary data and external sources like apartment lists. Internally, having Multilytics this year was especially important. Had we relied on standard forecasts from market leaders, like most firms, we would have been underwriting 6 to 7% rent growth in markets like Austin at the start of this year. This brings us to our outlook for 2024. We anticipate a rebound in year-over-year rent growth. However, context is crucial in interpreting these forecasts. Most markets are recovering from a period of negative growth, where a nominal increase simply signifies a return to peak levels rather than setting new records. Early indicators, such as a gradual uptick in year-over-year rent growth, suggest we might be on the right track. The question arises, how can positive growth occur amidst new supply influxes? The answer partially lies in the base effect. When a market experiences a decline, even a modest recovery can appear significant due to a lower starting point. However, there's more to this dynamic. Supply trends are complex, and a surge in new units doesn't automatically lead to lower rents. Factors like location, desirability, demographic shifts, economic conditions, and notably the interplay between income growth, housing affordability, and rent affordability play a crucial role. Income growth, or the lack thereof, is a critical element in this equation. In many markets, wage increases did not keep pace with the cost of living, but this is beginning to change for many segments of the market. Moreover, the recent slowdown in construction activity adds another layer. This contraction, coupled with the lag in income growth relative to rental and housing costs, suggests that the rental market will be an especially critical component of the housing sector for 2024 and into 2025. In summary, our predictions for 2024 are rooted in a comprehensive understanding of market dynamics, informed by our proprietary models and exhaustive data analysis, and we will continuously publish our forecast performance without adjusting initial forecasts as we go through the year. Thank you all for your time, and I will now pass it back to Dave to cover the next prediction.
Thank you, Ryan. Your work here has revolutionized the way that we analyze micro and macro trends, and it's been truly remarkable what you and your team have built here. So very proud of the work that you have done. It's made us better at every level. Thank you for passing the baton to me. I'm going to take us home and cover predictions 7 through 10, which will cover a number of thoughts on distressed asset sales, home prices, insurance rates, and ultimately industry consolidation. Prediction number 7 here is lots of distressed assets will be available for sale. And Dave covered a number of the reasons why and some of the macro and micro challenges that we've seen within the industry. But to consolidate some of the points that he made, the main driver behind this is the significant amount of sales that occurred in the post-COVID run-up at inflated prices. So to put this in context, nearly $700 billion in multifamily properties traded hands between 2021 and 2022. So they were averaging about $350 billion per year. And if we had a chart up, it would show that the long-term average volume of trades is much closer to 100 to 150 billion annually. So again, contextually, that's roughly 2.5 to 3 times historical volumes that traded at these inflated prices that were largely driven by at first low interest rates and then supplemented by operating fundamentals. Roughly 1/3 of these assets that were purchased use some sort of floating rate short-term bridge debt. And Dave gave a very specific example of a project in Phoenix, an infill Phoenix that we looked at that was a victim of short-term borrowing rates. And that specific example he cited, that property closed roughly 18 months ago. So this value erosion and level of distress has actually moved pretty quickly. So the ones the assets that were purchased during this inflated period of time using floating rate bridge debt are really the ones that are going to be most in trouble. And what this slide shows is in 2023 and through 2026, a percentage of the total maturities for the year or vintage year that debt was originated. And the groupings here don't perfectly correlate with my previously quoted stats. They group together 2021 here and 2022 through 2023. But the takeaway here is to focus on the gray bars. And these are the loans that are most in trouble. So if you look at the gray bars here in terms of maturities this year, next year, and 2025, 87 billion, 97 billion, 63 billion. So just under 250 billion in total, or roughly, as I quoted earlier, 1/3 of the trades that happened in 21 through 2022. Now, I want to note that not all of these loans will be in trouble. Some of these borrowers will be able to work out some extensions with their lenders. Frankly, some of these lenders don't want the assets back. Some of these borrowers will be able to come to the table with what's called a cash-in refinance. They'll be able to come to their lender and pay down their principal balance to bring it back into metrics that are acceptable to the lender. And then others will be able to hold on through getting some sort of extension through replacement bridge capital. And we've written a lot of thought leadership pieces on this. But what is replacement bridge capital or rescue capital? Has all kinds of names. It could be any sort of combination of new senior debt with preferred equity, new senior debt with mezzanine financing, a larger stretch senior position, basically saying that there's a new capital provider will come in to take out the old lender. So not all of those will be saved. A number of scenarios that will exist will ultimately result in the lender driven sales of these assets. And that was the exact example that Dave just gave, which is the lender is effectively driving the asset sale on the projects in Phoenix, not so much the one in Tampa, but definitely the one in Phoenix. So we're going to start to see some of those opportunities roll through the system. We're already starting to see them now. And as Dave indicated, we're still not yet a buyer at some of these levels. We're still holding on, waiting for additional reduction in pricing to occur. We're looking for that very important moment in time. And so are other buyers, certainly the marketplace too, for when you can achieve positive leverage. We think this is going to be a great buying opportunity next year and then the year after, maybe even into 2026. And as Dave mentioned, we've been patiently waiting on the sidelines since February of 2020, which is when we completed our last acquisition as a firm. On the next slide, we'll talk a little bit about home pricing. Again, Dave covered this previously and talked about some of the real challenges that are facing home buyers in the marketplace. It's not just the fact that interest rates are at 7%, some cases even higher. It's not just solely due to the fact that we are now at historically wide rent versus own gap in terms of the monthly cost of ownership versus the average rental rates, which that slide on prediction 3 did a great job of showing that example. I mean, those are certainly large drivers of the issue, but really what's keeping prices inflated at this point, we believe, is that no one's moving. I mean, there's a lot of folks that are locked into long-term fixed rate mortgages that are not at 6%, not at 7%. I mean, they're at 5%. In some cases, they're even lower. So there's a few reasons that are keeping people in their homes. That would be one of the biggest reasons, is that you're not running out to go pay an elevated price for a home and then replace it with a 7% mortgage when you've got a 4% rate at a much lower price that you're locked in at. There's also economic uncertainty, and Dave touched on a lot of the issues that are facing the country right now. But people are unlikely to move if they're concerned about losing their job. So we believe when the economy starts to rebound and see some firm footing and job growth really starts to ramp up in terms of new job formation in Q3 of 2024, that's when we believe people will start moving again. And that what that will do is drive up the availability of supply and inventories. Home builders are doing their best to repopulate and build new supply. But as Dave mentioned, there's been a lot of articles written about this. I mean, right now we are still playing catch up from the lag from the GFC, and we're somewhere in the neighborhood of between 4.5 and 6 million homes of undersupply in this country, depending on which research piece you read. So we're not doing our part in terms of building new supply to meet the needs that will create some equilibrium in pricing. So we believe once the home buyer feels more confident about their economic prospects, they'll start to move, and this pricing will start to fall. Now, we do think that the pricing and home values will be felt universally across markets in the United States, but there's also likely to be more pronounced declines in the northern and western cities here in the U.S. that are still undergoing a pretty dramatic demographic shift that certainly started in COVID, but continues to this day. Next slide, we'll talk a little bit about insurance rates. And what's interesting here is that for the most of my investment career, inputting the insurance premiums and the underwriting into our models to calculate investment returns was really a box check. And it was largely validated by using the same inputs that we had used for 3 to 5 years. Well, due to the increased frequency and severity of weather-related disasters, named storms, so on and so forth, and the rise of replacement costs that we've talked a lot about, insurance were priced in a really violent way in 2022. And it was truly unprecedented in a lot of different markets. So in some coastal markets, this represented a 200 to 300% increase in costs. So this completely blows up pro formas for many owners. And what changing these assumptions on the fly, because a lot of the buyers in the marketplace were getting information that was changing by the week from their insurance providers. This resulted in walkaway decisions for a number of buyers that were proceeding at the closing table. Because these inputs affect all aspects of the pro forma, not just for buyers, but for lenders. So it's impacting valuation and overall operating yields. So this has been a big blow to our marketplace here in the last year to year and a half. And while we think that it's possible that we might see some reprieve from these levels, if you start to see the severity of named storms and weather events starts to decrease and more capital starts to flow into the reinsurance market, and you've got more participants in the marketplace, we might see some reduction here. But at the end of the day, we believe these rates are fairly sticky, and we might not see these 20 to 40% increases that we've seen or in some cases 200 to 300% increases in the coastal markets. We think those days are gone, and we're going to revert more back towards a more typical inflationary increase from here. But we don't see these levels going back down to 2019, 2020 levels. Our last slide, our last prediction, we don't have a great chart for this one, and this is really more somewhat anecdotal in nature, but we saw this in the GFC. And this picture of the two gentlemen walking out with the Lehman sign, I actually think this was the Lehman office in London, not the one in New York. But 15 years later, still conjures up some pain from me personally. I mean, I was very close to being one of those gentlemen there carrying that sign out in 2009. And what happened during that period is you saw a lot of consolidation amongst the well-heeled stable, large players of the industry. And then, as we noted several times throughout this presentation, there have been a number of shocks to the financial, but most importantly to our ecosystem here in commercial real estate over the past years. We've talked about a lot of them. It's the historically fast-paced increase in interest rates, declining valuations, peak new apartment deliveries, and the unprecedented rise in insurance costs that I just covered. There's been a lot of stress in our environment, in our industry in the past 2 years, and setting aside COVID, which exacerbated some of these issues. But so taking a page out of the playbook from the GFC, I think we're already starting to see this now. A number of the larger and again, better capitalized firms will start to consolidate and acquire or merge with some of the smaller and the weaker firms. And that's going to expand the entire ecosystem. That's going to be developers, sponsors, private equity investment managers, property managers. We'll start to see this at all levels. And some of these firms actually will go out of business and cease to exist. So this disruption is going to provide additional opportunities in the marketplace for firms to grow and create efficiencies, and Origin stands ready to benefit from this as well. We could spend some more time talking about the adoption of technological advancements. We're not the only firm that is incorporating data science into what we do, although we think we have the best. Shout out to you, Ryan, and our team. But that will also, technological advancements will also help create enhanced consolidation opportunities within the space. So we stand ready to benefit, frankly, from a lot of these trends that we predicted, notably from the consolidation standpoint. But really, we believe this presents a generational buying opportunity as we see some of these asset sales come to market due to the run-up in valuations that we saw the past couple of years. So I think, Dave, that wraps up. That's prediction number 10. So we're at the end of the slide deck, and I will kick it back to you.
Okay. We have 11 fresh questions, and so keep sending them in. We'll stay on. We're right on schedule, which is really amazing because we had 3 people presenting, and that's a lot. So proud of that. I'm going to start the questions, and the first is from OV that came in early. If you actually, Owen, sorry, I believe Owen, and this is in the chat. So I will cover chat questions, Q&A questions, whatever you want. His question is very specific. Do we allocate in New York? We don't, Owen. We only invest in markets where we work and live. And so we have regional offices in the Southeast, Texas, and Southwest. I manage those teams, so does Dave. So we don't, if we were to add New York, we don't intend to. It would take years for us to be comfortable making an investment there. So we don't do that. I'm going to skip down to the next question, which is Alex had a question. What is the risk of rent moratoriums being reinstated? I don't know if you're talking about eviction or rent caps. In terms of eviction moratoriums, I think the risk is incredibly low. That was a one-time event because of COVID. Unless there's another pandemic, I think that's very low. However, localized communities that put rent caps, I know New York does, San Francisco does. The markets that we're in, that risk is incredibly low too. We are in traditionally pro-business free market states like Texas, Georgia, North Carolina, Tennessee, Arizona, Colorado, you get it. And we tend to avoid states that would have a rent cap in them, but it's not for that reason. It's more because we find that operating margins and population flows, which drive rents, are moving towards those areas. And that yields, that shows up in your work, Ryan. When you're looking at census data, and importantly, the machine learning is pricing that in, it's using it. Okay, I'm going to incorporate you guys now. Dave, this is a great question for you, and it's a 3-parter. I love it. Chad, 3 questions in one, but they're interrelated. basically he's asking, where is the distress going to be most acute? And I think he also is he's equating distress or the lowest prices with the best opportunity. And I want you to also challenge that notion, because I can tell you, and you were here for it, Dave, oftentimes the best returns come from, I'll quote Charlie Munger for a second, who's far smarter than me. He taught Warren Buffett that oftentimes you buy great companies at fair prices instead of not so great companies at really cheap prices. And so like I'll let you answer this, but I also want you to address why buying the cheapest isn't always the best.
Yeah, so it's a great question, and it's actually one that we spend a lot of time within Origin discussing and shaping and building strategy and policy around that. Where do I think the best opportunities are going to lie? I'll say where's the most distress going to occur? I believe it's going to occur in the markets that we saw the most hyperbolic run up in pricing. And I'm gonna talk about Origin markets specifically. I'm gonna refrain from talking about markets that we don't invest in, which are large gateway coastal markets. But I would say that kind of the exhibit A would be some of the markets that Dave touched on, right? So it's Phoenix and Tampa. Those are the markets that we saw the largest run up in valuation in the shortest period of time. And so where did we see the largest run up in valuation in particular? It was really a lot in the workforce housing properties. The properties that Dave referred to were not workforce housing. They were newer vintage Class A, where we saw the biggest run up in the properties that traded effectively at replacement costs were Class B 1970s, 1980s vintage assets in markets like Phoenix and Tampa, and in some cases in Dallas, where you saw a lot of these buyers and sponsors emerge using bridge debt. So that's where we're going to, and so markets like Tampa, I'll throw Orlando in there as an example, but anything that has a coastal location to it saw a double whammy. It saw the run up in pricing due to fuel from interest rates, but now it's also getting crushed by insurance too, which we talked about. So that is creating a huge impact. So if you look at where do I think most of the stress is going to lie, it's going to be in older vintage workforce housing assets on the coast. So that, and to get back to your point, Dave, on why we're not necessarily going to be chasing those opportunities is because of exactly what you just said. When I first came to Origin, a number of our early deals that we did were, vagaries from the GFC. We bought assets that I don't think we'll ever see this pricing again. I hope because we'll have bigger problems, but we were buying assets for 11 to 15,000 a unit in Atlanta. Definitely bottom feeding and distressed assets, but we never saw $1 of cash flow until we sold the asset. I mean, they were great returns. We bought them at the right place, but operationally provided no yield. And we actually outperformed those investments on a number of higher quality projects where we actually had higher quality tenancy. We actually saw cash flow along the way. So from a risk, not only an absolute return, but certainly from a risk adjusted return, we made better investments out of the GFC. And I don't see the same level of distress that we saw in 2009 through 2011 existing and emerging in this next 2-year period. So we're going to stay the course. We like our tenancy. We like the quality of the product that we are investing in and building. So we're going to stick to our knitting. And we believe we're actually going to find better investment opportunities and higher quality assets.
Yeah, there's no question. If there's going to be distress, we'll see, if not all of it, damn near all of it. And so we get a lot of questions about, are you going to have a distress fund? and the answer is, of course, we'll have a distressed fund when distress emerges. That's compelling, and we will see it. We live in all the markets. We're respected in all the markets. We understand how to price and operate. If it's going to happen, yes, we will have a distress fund, but we don't want to raise a distress fund until there's distress that we find compelling, and that hasn't happened yet. Which segues into the next question from Chad. With so much dry capital on the sidelines for multifamily, do you think that we'll have price support? And I get that question a lot too. I can tell you in 09, and I'm not suggesting this is 09, but the last major correction, I heard that the entire time. I heard it for 2 years. There's so much powder, there's so much powder. And there was no one buying. It just kept going lower and lower. So I don't know if that's a viable argument. It could be, it's a probability. But I can tell you, I've seen similar situation. And, you know, dry powder tends to be smart too. And they have a discount rate on equity and they want to see that it's met and in a way that's predictable. And you could hear Dave Welk say that before. He said, you know, till we see positive leverage, we're not really going to start doing this. Well, we have a lot of dry powder. So if Dave Welk is indicative of what's out there, we'll buy, but we're not there yet. So I'm not sure you can count on that just yet. So I already answered, Jeremy, your question. Will we open a distressed fund? That will be market dependent. And we also have a multi-strat fund called the Income Plus Fund that will buy distressed assets. It can buy existing stabilized assets. It just hasn't, because we haven't bought a direct asset in 4 years. As these market dynamics change, the first thing we'll do is start reinvesting and redirecting capital in Income Plus that currently is going into preferred equity, so much more protected positions. We'll start sending that into the distress space. If the opportunity set is big, then we'll raise a fund, and that's a probability for next year. It could happen. Okay, and then I'm moving into. Oh, I think there's a second question from, or this is from Davis. Sorry, Ryan, perhaps you can answer this, but he's asking about how we underwrite rent growth during construction periods, or you could, Dave. We've been pretty consistent about that. And then also, how do we underwrite cap rates, and then maybe talk about how we do it in our own models with drifting the cap rates, and how that's really protected both the untrended rents and developing to a wide margin and drifting our cap rates and having the deal support it. It's really protected our returns of our development funds in a way that maybe other funds weren't as protected.
Yeah, I can cover that quickly, Dave. So in terms of what we do during construction, we leave our rents untrended. Very simply, we use an untrended return on cost analysis in every deal that we evaluate, and so we don't inflate rents, but we also don't inflate expenses either. So we're looking at, if the property was built today and it opened, what would the yield be based on those inputs? Which, as Dave mentioned, I think provides a level of comfort and security and conservatism to our returns. Now, what's interesting is we layer in the work that Ryan and our data science team do, and they're providing forecasts over the next 5 years and what we think rents are going to do. So we also layer those assumptions into our underwriting, and we look at a trended return on cost. And so what Ryan's forecasts are showing in pretty much all of our markets is that we're showing a dip next year in rents, and the slide showed that. But then we show a recovery. And so what happens in the way our model works is that we're building for 20 to 24 months. We leave those rents untrended until we start leasing up, which generally is around month 18. Then we start to trend rents a little bit. Well, in Ryan's forecasts, rents go down and they come back up. So by the time that we open our doors, a lot of that movement in the marketplace has shifted through. And so then we apply Ryan's forecast over a 5-year period. We look at our untrended rents that start trending again once we start leasing up, and we ensure that there is some level of buffer between the forecast that Ryan and his team generate over that entire 5-year period. And we line the two up, and we make sure that we are inside of the 5-year forecast. And we do take that trended return on cost, and we spend time reviewing that. And so it's important that we invest in areas that show the highest level of growth. So an untrended 6 in 2 different markets is not the same return. We look at where we believe growth is going to be the highest, and we give the most credit to the trended 6.7 versus a 6.2. So we use both trended and untrended, and because at the end of the day, those who can forecast growth, which is really what Ryan and our entire data science team have taken us to a whole new level, really unthinkable level in terms of the accuracy they've been able to achieve in predicting the future. Those who can best predict growth are going to win over the long term. So we use untrended and trended. What we do for cap rates is we drift. We spend a lot of time, and there was a question that came up in the Q or the chat feature. What are cap rates right now? Totally loaded question. Great one that everyone likes to ask. They're as they've always been. They vary by market. They vary by product type. But to put a number to them, they're still 5, right? In some cases, they're sub 5, and maybe they're 5.25. They're not 6. We spend time underwriting every deal that comes to market. We put our rents and our expenses to them. We're not seeing cap rates in our markets, Sunbelt and mountain regions. We're still firmly in the plus or minus 5% range. But we take that 5 and we grow it at 2% a year. So in simple terms, we're generally selling out in year 5 in our underwriting at a 5.5% inflated cap rate.
And so that's back to our funds, because there's a lot of investors on this. They're partners, and they're in Growth 1.4, and they're in QZ1, and they're QZ2. And, the natural question is, wow, there's been such a correction. Why is it that you still have good returns in these funds? And the answer is, number one, when cap rates were 3, 3.2, 3.3, 3.4, we never started underwriting below 4. We just didn't. And we said, I don't care what the market is. It shouldn't be there. And our deals need to start at a 4, and they need to end at a 4.4, right? Now, you could say, okay, well, it's 5, so it's underwater. No. When it was a 4, we were also developing to a 40 or 50% margin. So we were looking at developing to an untrended 5 to 5.3. And so there you are, right? So we still have real profits. And if you juxtapose that with the decision we didn't make, which was, okay, let's go buy a building, you have significant losses to your equity. If you capitalized it at 50-50 debt to equity, and you bought near the high, prices are down 20%, and I'm being nice. That's 20% of your 50%. You're down 40%. You'll make some back on cash flow, but not enough. So, you're reasonably down 25% on your investment over the last 3 years. So that's a pretty stark contrast. So if you're in funds that bought assets in 21, 22, and you were common equity, you should be asking your manager about how they come to valuations if they're telling you they're not, underwater, because they are. I also believe, this is the good news, if they can manage the cash flows and the debt expirations, I think that this is such a strong asset class, you'll make it back. I do believe that. That's just right now, that's where your halftime score is, if you will. Next question is investment opportunities. Sam, thanks for your question. Do we see opportunities in Chicago? The cap rates are a little bit higher here. You can get positive leverage day one. That might be true on lower quality Chicago assets. I don't think it's true on Class A. I don't think you can buy, to our underwriting, a 6 cap in Chicago. But maybe if it's an outlier, potentially. But I'll answer your question anyway. Actually, Ryan, this is a good one for you, because I know your time is valuable and you're not yet in the conversation. So please talk about our atemporal model briefly and how it would relate to Chicago buying at a slightly higher cap rate, versus a very strong atemporal growth asset in that model. And then I'll cover the next part, but you can just cover that part.
Certainly. So when we look at our forecasts, we have our general forecasting model that goes down to the submarket, frankly, the property level, and builds out a specific property for that granular or specific forecast for that granularity. When we look at markets, though, we really are interested in long range forecasts. And to do that, we need something we call an atemporal model that looks less, that doesn't weigh temporal features as much, such as past rent growth, and really focused on where demographics are going. Generally, what we've seen across the US is you want to be where units per capita long-term is moving in the right direction, meaning where you're going to have population growth that outpaces supply, and rent affordability. So where rents are going to become more affordable over time, even with growth. So what does that look like? That's going to be a city with especially high population and income growth. For us, over the long term, Chicago doesn't look to be that market. And we're more interested in a place like, say, Dallas or even a Phoenix over the long term. That might not be true over a 1 or 2 year period, but when we look at 5 to 10 year periods, that's really what's going to drive growth. And in the long term, we believe values.
And Dave touched on this too, and we're a little bit over, so I want to be very brief. But the last 2 assets we purchased, one was in Austin, a suburb north of Austin, Round Rock, and the other was in West Loop, Chicago, and both are in Income Plus. And now fast forward almost 4 years, they were both purchased at great prices. That's the analogy of getting edge on the buy. Both had edge on the buy. But it's 4 years later, and what's really happened is what Dave spoke to, which is the trended rent, right? The untrended rent is kind of the good buy. In development, it's a little bit different, but similar. I'm making an analogy here. And what's happened is Monroe Aberdeen, that's the West Loop, Chicago, it's done well. It's probably up 40, 50%. Fine. You know, that's a fine return. Great. Round Rock is up 150%. And that's all. And yes, it went up even more, and now it's down. But net on equity, one has trounced the other. And that's the atemporal model. And even in development, we can get fixated on the return on cost and the margin. And it's important. And we do that work. But what's more important, because we're a long-term holder, and if you partner with us, you are too, QOZ deals. These are 10-year deals. You know, all of our development funds have options to hold because you get taxed. And so why do you want to pay taxes and reinvest post-tax? You know, we or you, we have the same post-tax goals you do. So the point is, if you're a long-term holder, you really want to look at long-term. If Sam, your question is, can I buy and flip an asset in a couple of years? Where would I rather do it? You could make a better argument for any city where you get a lot of margin on the way in. That's not our lens, because you know our lens and our investor lens is one of a longer term investor. It's just that you build wealth by owning great assets for long periods of time, and the added benefit is tax efficiency. Robert asked a question. Oh, it's a comment. Thank you, Robert. He says, I hope I'm reading it live. Listening to you always makes me thankful to be a client in 3 Origin funds. Well, thank you. I was a little nervous reading that, but it was a good comment. Thank you. No, I'm serious. All kidding aside, my first career was in an industry where I had no clients, and I did it for 12 years. It was a privately financed hedge fund. We went to work every day. We traded partner capital, and we tried to go home with more. And I've never been more, I'm just really thankful that I moved to a business where we do have clients. We have thousands of clients. And it means so much to me that we work really hard and we're honest and transparent and we win with you and we're aligned and all these things. And it's not BS, it's real. And it means a lot to me and all of our team that, you know, you feel that way. I'm sure not everyone feels that way. We have a lot of clients, but it means a lot when I read it and see it. Chad says, love the investment philosophy. Thanks for painting the color. And rest in peace, Charlie Munger. Agreed. Chad, I learned that Charlie Munger, you probably know this, he was playing with his sister. I think it was his sister, but it might have been his cousin. Fact check me on this. It was either his cousin or sister, but when he was young, and a rabid dog bit his either sister or cousin, and she died, and he didn't. And he spent his whole life like thinking about that and the arbitrary nature of life. It's just are we investing in Denver, Phoenix, California? This is Richard. Thanks, Richard. Yes, we are in Denver and Phoenix and Salt Lake City. Again, we added Salt Lake City because of Ryan's work, and it was scoring high in the atemporal model for years. Same with Tucson. So we added Tucson. We don't invest in Chicago, even though we're headquartered here, because of the atemporal model. And so we used to invest in Chicago. We stopped. California is a no. We don't do that. Okay. Oh, someone had already answered that, I guess, in the chat. I'm in the chat. Oh my God. I haven't even started the Q&A stuff, have I, Dave?
We got a motor.
Oh my God.
28 Q&A questions.
All right. I'm going to move to the Q&A. I was stuck in the chat. Why don't you start us off? And by the way, how many people are? Oh, there's still 250 people on. So look, we're going to stay on as long as it takes. You'll let us know with your own vote. Everyone will get the recording. And by the way, if you haven't gotten your question answered, just email me, david@origininvestments.com. I don't care if you're a partner, a potential partner in the industry. We're committed to educating and helping people make better decisions, and it's fine. I'm not sorting here. David@origininvestments.com. Dave, take the first anonymous. It's a Phoenix rent growth question.
Well, I would love to kick this to Ryan.
Okay, yeah, do that.
All right,
So
thank
Ryan, you see in the chat? Okay.
Yep, I believe I see it. So this question is about our rent growth forecast in Phoenix and how it differs kind of from the market leaders. So what do we see in our model? So generally, as I mentioned before, we're really interested in units per capita and rent affordability. There are features that kind of differ by city in terms of what's predictive, but those two almost universally are going to drive a lot of what we see coming. So construction, I'll start with Phoenix. We shouldn't look at a market as a monolith. There's a lot of heterogeneity or differences between submarkets within a given market. So there are areas of Phoenix which we really, really like and others that we don't so much. And this generally correlates to where construction is. For us, we do see units per capita moving the right way with new population inflows, and the same thing with rent affordability, whereas rents are cheaper now than they've been and incomes are generally going to move in the right direction. This helps us get back to where we were. And because Phoenix has seen such a decline in rents, your percent increase looks rather large relative to other markets. But again, generally, this is just a function of the base effect, and you're kind of just getting back to peak pricing levels with a higher population, greater incomes, but a bit more units as well, which is why you're not really hitting new highs.
Okay, I'm going to answer two because they pertain to my part of the presentation. So one's anonymous. Q3 GDP will be adjusted. Would it change your view? No, I'm aware that Q3 they always adjust GDP, and it probably will come down from that super high reading. But that's kind of my point. I think that'll get adjusted down, and I think GDP will continue coming down. This morning, the ADP was quite weak, and that's why yields went down again. It's not a trend yet, but it's starting to look like. And here's another point. You'll know, like right now, bad news is still good news for public markets because that equates to more Fed untightening, if you will, or cutting rates. There will come a time where bad news is bad news. And that's kind of my point. Like eventually bad news is not good news. And I think we're at the beginning of that. Robert asked a question about consumer balance sheets, and he's speaking to the higher cost of credit card debt, mortgage debt, that slide. My answer to that, Robert, is a balance sheet is it's a function of a lot of different variables, including your own spending habits, your assets, and if they're going up or down in value. And so if you look at 22 and 23, 22 was a terrible year for public markets, stock and bond. This year was mixed for bonds, but certainly good for stocks. But the net of the last 2 years is not great. So I don't think assets were the ones that were really helping you. Your own spending habits is consumer by consumer. But then on your income statement, which is the financing of your debt, unless it's fixed, it's up a lot. Your income is up too, generally. But my thesis is it's not up as much as the cost of financing what you have. Certainly not in that sort of middle America segment. So that's where I'm speaking to. But I don't think you can say consumer balance sheets are better. But email me, David at Origin Investments. We can talk about it. So John has a question. Thanks, John. What pressure do you think the current administration will apply to the Fed through the election? I'll kick that to you, Dave.
Pressure do you think the current administration will apply to? Well, I mean, it's a really good question, John. I'm trying to remove wading into these waters about Fed action, but I mean, look, I think Dave talked about this before. It's going to be interesting to see what happens this year. I don't think it's coincidence that Dave just answered this question previously, that we've seen revisions to job numbers or GDP numbers, that most notably job numbers that show declines after revision. So, I mean, I don't know if there's a little bit of manipulation that's going on here heading to an election, but I think the Fed's going to do their best to remain partial and independent. But I think at the end of the day, this current administration is going to certainly make loud noises to get the Fed to push rates lower to stimulate the economy. I don't know if they're going to cave. I'm actually going to side with the Fed and their mandate and goal to be independent, from a fiscal versus policy perspective. So I think the pressure will be there. I'm going to give it to my man Jay Powell and the Fed to remain somewhat independent going into next year. So that's a very hard question to answer because I don't know, but I believe we'll see some pressure from the current administration on rates.
Okay, anonymous question, and we're going to pick up the pace here. We're down to 190 participants, so we're going to pick up the pace, guys, including me. So I spoke to negative leverage, so did you, Dave, and we got a couple of these questions. Essentially, the question is, if you think leases are below market and you can grow out, increase the cap rate, and get to positive leverage, or same idea with value add, all of those things go into our underwriting. So if we think that there's leases that are mispriced, our machine learning will be picking up on that. Our market knowledge will be picking up on that. So all of those things matter. And so, yes, we can see value within a rent roll today. Or if we think that there's the willingness and ability to pay for a value add, we can price that in. And so all those things are completely defensible in underwriting as long as it's defensible. And we're pretty conservative about things like that, but we do it. Manan, I hope I pronounced that right. If I didn't, email me and tell me what I did wrong. Do these predictions map into the opportunity and performance of our QOZ funds? Well, I talked about the safety of the funds because we're developing to a margin, because we don't trend rents, because we don't, we're drifting cap rates higher, et cetera. So I think our QOZ funds, Fund 1 and Fund 2, they're still doing quite well. If you're an investor in those funds, they're also long-term in terms of, and they're low debt to equity. So you're in markets that score very well in the atemporal models. And I think you'll be quite pleased with where rents go and where those funds go. But these are 10-year investments. Let me be clear about another thing. Multifamily has outperformed the stock market for the last 30 years. And so that's an insane statement. I had to look at it multiple times. I didn't quite believe it. And initially, because it's also lower risk than the S&P. And so I don't think that's changed. I think that we're equally set up to do that again. So that's QOZ. And then we're raising a third QOZ fund now. And I think this is an extraordinary time to be stepping into a new portfolio. And so I'm really excited about that fund because I think underwriting is very stretched right now. And you're going to get really interesting margin deals. The other thing I'll say is all the leverage is with equity now. And so we can do some really interesting things with owners of land, et cetera, that maybe you couldn't do 2 years ago. Okay, anonymous, another question. Given the big fall in interest rates, is now a good time to take out swaptions on our development deals? That's interesting. We had this conversation at our credit committee yesterday, or actually, yeah, yesterday, Tuesday. We will not most likely be using swaptions at this point. We'll be using swaps. Swaptions you pay premium for. Swaps are just a bet on interest rate direction, hedge, I should call it, with your lender. And you use the loan as collateral. And so because we're further along in our development, we have more loans and we can use those as collateral. The reason we used swaptions before is that we were earlier in the cycle of development. We didn't have the loans as collateral for a swap. And so a little bit in the weeds, but I think we will start hedging interest rates here because we can, and by the way, we're still talking about this, but because we're developing to a margin, we think we're good at the things we can control. It's a good idea to hedge the things you can't. And so that's just sound risk management in our opinion. Manan has another question. Can you share your thoughts about the single family rent market? I think she's talking, Dave, about build for rent. Can you speak to that? We're incredibly active in that market. So, and I know you're leading a lot of those deals. So please go.
Yeah, the not for rent market. I think
for sale market.
Okay. Yeah, I think it's the for sale market. Yeah, and I can take this one. So, I mean, it's certainly a segment of the economy and the ecosystem that we follow, because there's what's known as a shadow inventory. So, if we were completely oversupplied from a single family for sale market, I think, and we saw this in 08 and 09, there was a very large overhang of owner occupied, owned homes that then turned into the rental pool. Right now, I actually don't see that as a risk. And we said as much earlier and discussed on how we are 6 million units undersupplied in single family here. So I don't think most people are owning a single family and then renting them out. So I actually don't view this shadow inventory as a risk like it was in 08 or 09. I do think that we have a number of challenges for getting rezoning and entitlement through the timeline and the permitting process. A lot of our jurisdictions has increasingly grown. The process has become more complex. NIMBYism has really kept out new supply in a lot of markets. And what's interesting about, and the question came up earlier about rent control. Rent control has the inverse effect of what it's intended to do, because it stymies new development. So any sort of constriction of new development creates pressure on price, whether that be on the for sale side or on the rental rate side. So obviously we're a self-serving developer here, but if you look at the studies and Ryan can attest to this empirically, more supply is actually the best combatant to price and rental rate appreciation. So we should welcome new supply. And I'll answer one more question that Rob asked too on this topic of housing, and said, how is there so much undersupply of housing when the US has had so little immigration and population growth in recent years? And I'll answer this and Ryan can correct me if I'm wrong, but the short answer is we're not keeping up with our organic household formation in this country. That's really the reason. We don't necessarily even need to add new people into the US. What's happening is the Gen Z, the millennials are still working their way through the system, forming households, and we have not even kept pace with our actual organic internal household formation to address that, let alone any increases in the population that that will happen or have happened lately. Is that accurate, Ryan?
Yes. I would just add that it also depends by city. So some metros, as you know, are gaining population rather quickly, whereas others are losing population. And as such, there's kind of heterogeneity in where we need the most supply. Generally, we're going to be looking at the most undersupplied markets.
So Ryan, while you're on the mic, one more question from Ginny was, what are the biggest forecasting issues that you may currently be seeing in Multilytics?
So one thing I'd love to work on is just to get more unit data. The more data we have, the more we can do. So we've been looking at a bunch of different methods to kind of gather daily rental data rather than kind of aggregate monthly data from various sources. And not to say too much, but with some recent advancements in AI, there's some really cool tricks we can use from scraping the web and other new methods of data collection that I'm excited to see improve our process.
And Ryan, another question, we got this in like 5 different forms, is what are the top markets that Multilytics, our machine learning, is predicting for next year? Go ahead.
So again, generally we like the Southeast, Southwest markets, especially over the long term. Now, part of that for 2024 is again just the base effect because you went down more in these areas. A slight increase kind of looks overinflated, or just getting back to where you were looks like a lot of growth. And this is a similar kind of dynamic to what we saw in a place like Chicago in 2022, where you kind of got back to pre-COVID levels, and it looked like there was a ton of rent growth just because rents had fallen so much. Beyond 2024 into 2025 in the next 5 years, we really like the high growth markets. I don't think that's especially surprising given kind of the dynamic we've set up with units per capita and rent affordability ratios. Dallas is uniquely interesting, especially kind of once we get through these supply concerns, and some markets in Florida as well. I did see a couple questions on climate change impacting those markets. Generally, we're just going to default to what domain theory says. So that's the latest academic research on what may happen to populations given sea level rise, sea level rise, wet bulb effect, and kind of other impacts of climate change. And generally what that research is pointing to is people moving to the nearest livable area. So whereas Miami may be really, really hindered by sea level rise, a place like Orlando may actually benefit by that population moving. That's somewhat of a unique perspective in the research. Originally going into this, I believed it was going to say there were going to be safe havens like Chicago that everyone will move to. Certainly some research says that, but there's a bit of debate amongst scholars. Fortunately though, within the next 10 to 15 years, we don't expect a huge impact on the markets we're interested in. One way we look at this on the data science team is none of our markets are going to become hotter year round than Phoenix currently is, and Phoenix still has many people moving there.
So we're going to wind this down. I'm going to answer a couple questions. Everyone's going to get the deck. There's been a lot of that question. So if you asked it, you'll get it. You'll get the recording and the deck. I'm going to answer 2, Dave. If you want to answer more, I'll hand it to you. But Greg, you asked a question about public REITs. These are multifamily REITs. He asked if we're investing in them. They've gone up quite a bit. You've mentioned 15% in the last month. That's true. What's also true is they're down 40 to 50% in the last 12 months. So that's kind of what Ryan is talking about too, which is this idea if you come off a bottom, it can be a big number, but what's the bigger picture? It's another indication, down 50 when your 1-to-1 debt to equity is implying, 25% correction in equity, which it kind of has been. And we talked about that before. So that's another way to triangulate where asset values are today. We are not buying public REITs. That's not our mandate, really. You're hiring us to buy or develop or value add private assets. In most of our equity funds, we're very active in debt. We issue debt. We buy Freddie Mac Ks, but we have bought REITs in the past, and I thought about it a lot. Although I look at it for sure, and we do roll up of cap rate analysis in it, and we discuss it. I don't think you've hired us to do that, to be a public-private manager, and so I'm really sort of getting away from it. The other thing I would tell you is, for the Dave Scherer account, I did buy it. I bought it about a month ago, and it has riptire. I didn't buy I think you're citing ETFs. I bought the actual stocks. I bought Camden. I bought MAA. I bought ABB. I bought UDR. I bought Equity Residential. And yeah, they've gone higher. It was probably grossly overdone at that point. But interest rates have also gone lower, and they're very sensitive to those moves. So, if interest rates start going up, they might also start reversing back. So that's that answer. There's also a question that I wanted to answer about, again, it's about underwriting. And I've kind of lost the question in the sea of questions, but the question was really about how we underwrite. And specifically, would we ever underwrite a deal at a lower cap rate, which than we either developed it to on an untrended basis or bought it? And the answer is no. We won't do that. So I'm not suggesting that. I know there's industry people here, and if you want to do that, you can do that. And your investors, if they want to invest in those deals, I'm not saying they won't work. It's just not the risk management that we employ. So it's unequivocally no. Dave, do you want to cover anything before I sign us off?
No, sorry, I deleted a couple of those questions on exit caps because I had planned to cover those, but you picked those up, and I'm just kind of scrolling through what else hasn't been touched on here. OZ development deals in high growth markets in Texas. Yes. We would do those deals. Question is, if is there an existing multifamily that is B grade but needs a CapEx plan, would you invest? Generally, no. We talked about that earlier, and as to why we're focused on higher quality assets. I think that's pretty much it. So did our best, got through a lot.
We did. Thank everyone for your time. First of all, there's still 150 people on. That's a huge testament to you're valuing what you hear, and that means a lot to us. If we didn't answer your question, David@origininvestments.com, just email me, and we'll either I'll answer it or I'll send it to someone at Origin that will answer it. We'll do this every year. We'll publish the article. We'll send the deck. And importantly, we'll hold ourselves accountable to what we're saying, and you'll get that in about 12 months. Thank you for your time. Have a great day, everyone. And Ryan and Dave, I really appreciate you joining.